Hey everyone, welcome back. Welcome back to Tax Tuesdays every other week, bringing tax knowledge to the masses. You're certainly in the right place if that's what you're looking for. We'll let everyone trickle in here for a moment. This is a live event, so we'll let everyone a chance to give everyone a chance to come on in the room here. But again, you are in the right place. We are bringing tax knowledge to the masses. Give us a shout out in the chat. Most of you are here again, and anyone here for their first time, shout us out in the chat where you're from, what are you working on, what's on your mind. We're going over your questions today, as usual.
As long as they're tax related.
As long as they're tax related. Of course, this is Tax Tuesday. You submit your questions. Elliot goes through every single one of them. He really does. He reads all the questions, and we take your questions, kind of format them together, compile them in a way that we hope brings the most value to you and here in this kind of format. And we do this every other week. So welcome to Tax Tuesday live, going over your tax questions. Shout us out in the chat. Let us know where you're from. We got the Q&A section.
The first timer from Tacoma.
Ooh, excellent.
One of our offices.
Oh, yeah. We got offices up there. You can go say hi to the crew, Clinton, the Coonses. And shout us out where you're from. Have everyone go ahead and hop on in the room here. Definitely happy to have you guys. We're covering some super exciting topics today. We're obviously going to hop into a bunch of the real estate stuff we always go into, but we're going to talk about some fun tax rates plus some kind of more high dollar stuff. So welcome back to Tax Tuesdays. My name is Barley Bowler. I'm one of the CPAs and tax advisors here. So very happy to have you guys back. Joined by Mr. Elliot Thomas.
Manager tax advisors.
Yes, sir. We got an attorney and the CPA in the house, guys, so we'll try to keep the jokes, not too dry, but do have a lot of fun material to go over today. So where do we got people joining us from?
We got New York all over the place, a couple of Washington spots.
Oh, great.
I saw a Puerto Rico there earlier.
Nice, PR.
Miami.
Love Florida in the house,
Florida,
as usual.
Yep. New York, Texas, Tampa.
Excellent. Well, so you guys know the drill. We're going over your questions. This is a live feature. You guys can submit your questions. Again, we read all the questions. You might recognize your question. We may format them a little bit, just kind of make them more kind of palatable for the general masses here. But certainly going to go over the questions. Email your questions to the Tax Tuesday address here. If you need a detailed response, this is a general form, right? We want to get as specific as we can, provide as much information to you as we can. That really is our goal here as part of the kind of whole educational aspect of this company. We want to give you as much as we can. The only reason we're not going to give you information is if it's too detailed or specific, you need calculations. We don't want to steer you on the wrong track, right? So that's when we encourage you to become a tax client, set up a tax call. We can do a one-on-one call. We have the Platinum portal you can submit written questions to. So lots of ways to get your tax questions answered.
We got one client driving a concrete mixer.
Right now, listening in.
Yeah, don't worry, the humor won't be that great. No danger of you falling off the road.
Right. Keep your eyes on the taxes. Fast, fun, educational. We want to give back and help educate. Yeah, that really is the point. It seems like there's a disconnect between kind of what I have a background in business. I see the tax code as almost overly burdensome, right? We're focused on Main Street businesses here. How do we build wealth, build success, build our knowledge? So that's just part of our mission here, bringing up that kind of that learning curve to help digest all this legal and accounting and tax stuff. I mean, I went to school for this stuff for a long time. It's still confusing to me, a lot of these concepts, right? You just have to go over them, repetition. A lot of the new tax code came out, so a lot of new tax laws, but
or just keep showing up here.
Or just keep showing up here every other week and submit whatever questions you have. And we do have the other services. We're going to be going over those. So anything we want to get into before we hop into the questions?
No, I think we're good to go.
All righty. So we'll just read through the questions real quick here, give you guys an idea of what we're working with. I have a large capital loss. How are capital losses deducted? When should I consider taking a tax write-off by closing the position, unrealized versus realized gains? When should I take a tax write-off by closing a position with a loss?
Good stuff there. And these first couple are going to be capital gains orientated. My wife and I are considering investing in Bitcoin. What are the tax advantages or disadvantages of doing so for that type of investment?
Yep. I do a lot of stock buying and selling. Is it tax efficient to set up a business entity? We'll certainly talk about that. Yeah, and like Elliot said, these are going to kind of follow a theme here. Elliot really does put time into these to try and have some sort of congruent flow, which is challenging when we're talking about complex tax stuff, but
until we get to the next three questions.
We're supposed to get to the last one.
Can you explain what differentiates whether a real estate rental deduction would be categorized as a maintenance repair deduction versus a capital expense deduction?
Right.
and provide examples. Please explain how these are treated differently from a tax perspective as well.
Yep, and they are treated differently. You're absolutely right. Can I deduct lost rent from a deadbeat tenant? Great question. A lot of you guys are landlords. We want to
Get
cover
that one
that.
more often than one might think. It's a good question. I've heard you talk about renovations made to rental property and tax advantages, but what about for my primary residence? I need to finish the basement, upgrade the house.
Yep.
This is also the address of my C-Corp business is registered to, and I operate a home office out of it. When I complete taxes next year, is there anything specific that I can take advantage of due to this large expense?
Yeah, great question. I'm giving Elliot all the long ones here. Can I do a 1031 exchange on real property? What's real property? We'll be covering that.
I bought a rental property in California in 2019 for $700,000 as replacement property from a 1031 exchange. $400,000 was from the sale of rental property in Seattle, Washington. $300,000 from my savings. So we put some cash in there. I took a loan also of $600,000 for expansion and repairs in January of 25. How much of the money I invested from my personal savings, the $300,000, can I get back without having to pay tax? I listed my rental property for $935,000, so a lot to tear apart there.
Right, and that kind of is going to combine a bunch of the pieces we talked about, just kind of building up to that. Finally here, I'm selling my personal residence next year, so not a business asset. We're currently have an anticipated capital gain of $1 million. I'll be paying taxes, we should say I anticipated paying taxes on $500,000 of the capital gain, above the capital gain exclusion for married filing joint. We're talking about the Section 121 exclusion there, obviously. What tax strategy would you suggest that I may plan to use in order to mitigate paying federal taxes against the $500K capital gains? Could I do a 1031 exchange or of a personal residence? So that's question one. Can we do a 1031 exchange on a personal residence? Can we convert the personal residence to a rental and then sell it in 1 to 2 years? We can look at that as well. I've also heard Toby talking about sell your residence to your S-Corp. There's maybe a strategy there, but I don't have a business or an S-Corporation set up. We'll certainly be discussing that. I currently have an LLC managed disregarded entity for asset protection. Please advise on how to avoid or mitigate paying a large tax bill on an anticipated $500K capital gain from the sale of a personal residence. Great questions, and all kind of related.
Yes.
Put them all together so well. As usual, guys, want to make sure we put you on to the YouTube content. So much great content here. Toby obviously focused on a lot of the tax planning. Clint on the asset protection side. Of course, a lot of overlap. These interviews are great, guys. I mean, most recent, what was a recent one? Another good one about storage units recently, investing in storage units. Great information in there. Plus a good 2-hour section on the new tax bill.
Yep.
So if you want
to
dive in there, so a lot of good information on Toby and Clint's channels. Make sure you subscribe, as we are. Oh, didn't subscribe to Clint's page. Ooh, somebody's in trouble for that. And it looks like we got a live event coming up.
We
Maybe
do.
1 or 2. Tell us about it.
Yeah, where is that?
Looks like it's in Las Vegas, September 11th, 13th. We might even be there.
Yeah, it's going to be at the Durango Casino that I always
Durango.
call the Durango Lodge.
Right.
Accidentally. And beautiful place. We had our last event there. It was a really nice event. Got a lot of great feedback for that location. So we'll be there again. Only $99.
Yeah, right. Come on down. Fun
September
spot.
11th through the 13th coming up. Hit the little square there. Join us live.
Yeah, great time to be in Las Vegas too, boys. September weather, can hit the pool parties. You guys know what to do when you get here. I mean, after attending the tax asset protection workshop, of course.
Get the important stuff first.
So that was our, this was tax and asset protection live workshop, and here's our available dates for the next. This one's virtual though, right? Sorry.
That's correct. Yeah, right. Those are our Saturday ones. Yep. Exactly.
Make sure I got these straight. Should have done that first. But yeah, so we got a couple virtual about those events as well. Plenty more information on that, guys. If you guys any questions about that or want more information on those events, shout us out in the chat. Let us know in the Q&A. We can certainly provide that.
Very common for clients to go to more than one, just trying to catch everything, make sure they're up to date.
Yeah. We talk about the structure implementation workshop. We recommend watching that.
Absolutely.
You know, maybe every year or two, get another piece out of there. And you guys can scan this QR code right now. We're going to be going through questions. You guys can submit questions here in the Q&A kind of as we go. Plus, of course, you can submit questions at the Platinum portal. But you can also right now schedule a strategy session if you want to just get the ball rolling. You want to start talking shop right away. Scan that QR code and we can get that started. All right, should we hop right in?
Let's do it.
All right. I have a large capital loss, certain kind of categorical loss there. How are capital losses deducted? When should I consider taking a tax write-off by closing a position? With a loss, like when selling a stock when it's in the red, so to speak. So, what's a capital loss?
Yeah,
Elliot?
capital loss. Well, it's going to sound kind of comical, but it comes from the sale of a capital asset. That's going to be typically your stocks, right? Exactly. It's more that the code tells us what isn't a capital asset. But you're thinking stocks. If you had investments, it could be property, could be a rental property, something like that.
Sale of business assets.
Business assets, any of those things. What it's not inventory. It's certainly not any income or anything like that from services or things of that nature. So it's usually if you sell an asset that was used in a trade or business, that's typically what we're looking at for capital gains and losses.
Of course, we got the exception is the primary residence can also show up on your
Correct.
as a capital sale of a capital
Yeah, or
asset.
if you had gains from selling your own assets, they very likely would be capital as well from your personal assets. So it's really just anything other than the actions that create ordinary income is probably the better example. But stocks is the most common, things like that.
Right, of course.
Now, how they're deducted. We have a lot of special rules around how we deduct those capital losses. First of all, you can deduct them up to the amount of capital gains you have that year. We're always netting. When we were getting ready for this, Barley pointed out a really good way of looking at it. You have your long-term capital. That's anything that you held over a year. You have your short-term capital gains and losses. Anything we held less than a year. We net those two categories themselves, short-term capital gains, short-term capital losses, and then we do the same with the long-term, net those, and then we net the two piles together. We come up with a certain number. We either had too much or we gained or we had losses. If we had losses, we will have at that point wiped out all of our capital gains. And whatever losses we have left over, we can take up to $3,000 against our ordinary income.
Yep.
And so we see that a lot. If you have W-2 income or something like that, had some capital losses, you'll be able to offset $3,000 against that. All the rest, if we have continued capital losses, we're going to carry that over to the next year. So we had a little example. If you had like $100,000 of capital losses.
We could probably draw this out even, huh?
Yeah. So that could be long-term or short-term. It really doesn't matter. That's our capital loss. And let's say in the same year we had a gain of $40,000 capital gain. So what we'll do is we'll net those two and we'll come out with $60,000. And this is all what would show up on your return until we get that special $3,000. So we take
loss.
Yes, sir.
Loss.
And then we'll take that $3,000 against it. That $3,000 special, it's outside of our capital treatment. We can take that against any income on our return. But that's the limit, $3,000.
It's a capital. I'm calling it ordinary loss here because it offsets your ordinary. It's a capital loss, right? But it offsets all other forms of ordinary income. So I just put it as a capital ordinary loss.
Yeah, it's like a ace in the hole. Now these are the $57,000. Now, if we didn't have anything else going on in this example, that $60,000 cap loss, it would divide it by 3. That's going to be 20 years until you eat it all up. This has not been adjusted for inflation any time in recent memory. So I think I did a calculation maybe 7 years ago to kind of get an idea of what it would have been today if they had adjusted it for inflation. It'd be somewhere in the $20,000 range, as I recall. So
weren't you saying this is from the 50s?
It's a long time ago. Yeah, they're
literally from the.
Yeah.
That's when this limit was set.
Yeah, as I recall, all this came actually from an offshoot of World War II is what they did to get capital investments and things like that with these losses. So we're looking a long time ago.
Right.
Nonetheless, what we get to is that will just carry forward.
Yep.
Now, really what was asked here in the primary question was, am I forced to do that? Is there any way I could just hold back and not take that deduction and wait till a future year? Well, no, you have to follow those rules. We don't have a choice. They're not optional. So it's going to follow this pattern just as Barley laid out here. We got to subtract out that cap gain. We get the $60,000. We got to take that $3,000. That's going to net us $57,000. That carries over to next year, and we will rinse and repeat. If we don't have any other capital gains or no other capital activity, it'll just be $57,000. Subtract $3,000
every year.
Every year for a long time.
Or until you sell a rental or sell a pizza oven or something like that.
Something that will create some capital gains, and then we can net them just like we did to get that original 60. So that's how we handle the tax side of it. Now back to the question was, when should I close out a position? So if we had some stock and we know that was maybe at a gain would be the time. If we knew we had 60,000 cap loss sitting there, maybe we'd want to sell something that was or Bitcoin or something like that. Two reasons to do that we talked about. One might be that first of all, you just want to unload that position and recognize the gain, take the cash, and go home. Otherwise, you can maybe want to solidify the basis in that investment. So in other words, you sell it, take the 60,000 cash, you're going to have the write-off of the capital loss of 60,000, reinvest that cash back into that same stock, and now you'll just get it at the current basis. That way you've kind of strengthened your position in that stock and been able to take advantage of the gains that were there, but didn't have to pay much tax because you wrote off that gain against the 60,000, or the cap loss in this case,
So for those of you that don't do stock stuff, that probably didn't make what we're talking about is just adjusting the basis to lower our taxable gain. There's actually a little bit of tax planning we can do when we have these capital gains, capital losses. It does create a little bit of opportunities for some flexibility there.
Absolutely.
What was that? So, or are we on? Are we still on number one?
Yeah, we're ready.
Goodness, we haven't.
Yeah, we're ready for number two.
We haven't even got that. Let's see. I just wanted one other thing. So when you say closing a position, and obviously most of you guys know this, but we're talking about unrealized versus realized losses, right? If we have positions in stocks that go down in value, those won't offset any capital gains until we actually close. I know you were aware of this, but just for anyone that's unfamiliar with those terms, unrealized versus realized gains and losses, those are the ones that actually show up on our tax return, right? That offset or increase our income. But yeah, so now let's skip over to crypto.
Yes.
My wife and I are, let me get us back on the right page here, guys. All right. My wife and I are considering investing in Bitcoin, also considered a capital asset. In most cases, kind of depends on how you treat it. What are the tax advantages or disadvantages of this type of investment?
So Bitcoin's crypto. What do we got going on with crypto?
Well, I don't know. We don't know.
Yeah, the IRS came back and said, well, it's a personal asset, which means
it's not a security.
Exactly. So it means that when we sell or have gains or losses on the sell of it, it's going to be a capital gain or capital loss. So it fits in with what we were just talking about. We're going to have those same rules. We're going to be limited on losses to offsetting whatever capital gains we have, plus that $3,000 that goes against the ordinary. We'll call it the ordinary loss, as Barley pointed out. However, because it is a personal asset, it does have some different advantages and disadvantages. It doesn't have the wash sell rule. Well, what's that? The wash sell rule, getting back to stocks, where we really run into this, it says that if you sell a stock at a loss position, you go ahead and formally close out of that position, you can't come back and buy that stock and recognize a gain and use those losses if you're on either side of 30 days of when you sold the original position. So we call it the wash sell. So you could sell something at a loss, go back and buy the same position, but they're not going to allow you to use that loss to offset that new position or any gain like that. You have to wait 30 days to repurchase that same or like security. We don't have any of that with Bitcoin, with crypto. We don't run into the wash sell rules. So that's one advantage of it, certainly. Another advantage, we talked about the tax treatment as far as just the rates by being in capital. What's going on with our rates there in capital gains?
Yeah, capital gains rates, we consider those favorable tax rates. I mean, the highest tax rate federal is 37 plus, right? Some NIT,
yes, sir.
Maybe close to 40%. When we're talking capital gains tax rates, we're talking 0, 15, or 20%. The vast majority of us will fall in that 15% range. Is that... I thought I should have looked up that limit again. It's over 400 something, but I think that might have gone up even considerably more.
Yeah, each year those will go up a little bit, especially with the new bills.
But 15% compared to 37, 40-ish, right? That's a pretty massive difference. So we definitely consider that. So that's certainly one of the advantages to investing in cryptocurrency in general. Is treated as a capital asset.
And we have kind of
capital gains tax rates.
Absolutely. We have kind of an advantage and a disadvantage when it comes to crypto in that also there's people out there mining this stuff or staking where they have some Bitcoin and they're basically using it to make more. When we have that staking or mining, typically that's going to be ordinary. That's an activity. It's treated as ordinary income on your return. We're no longer in the realm of capital gains that we have been.
Yep. It's earned.
And often, because it's earned, I'm going to get hit with extra tax.
Yep.
our self-employment taxes, another 15.3% can be added on to the ordinary rates. So if we were at that 37 and we add another 15%, I don't know, it's a high number,
Right.
52, but it's pretty high.
Yeah.
All right, so we're looking at a lot in that case. Now that can be an advantage in that you have the opportunity to make your own Bitcoin, but you just get taxed heavier at it. But then the end product, you get paid in Bitcoin to mine it. You have the Bitcoin there, you paid tax on the earnings of it, but now it's back to a capital asset should you sell it in the future. So it's a unique investment in that you can earn and then later sell at a capital rate. So that is, that can be looked at as an advantage or disadvantage, depending on how you set it up. But that's kind of some of the tax attributes of it. The mining is something a lot of people don't think about, having that extra tax. I remember back when Bitcoin, probably about 10 years ago when we really started to hear about it a lot more, everybody said it couldn't be taxed. Yeah, right, good one. We found no problem with the IRS finding a way to tax that. I think, the lower, like you pointed out, the lower tax rate at the capital side. And, we're not investment advisors, but really the Bitcoin's not backed by anything. These cryptocurrencies aren't, it's not like you have a share of Tesla, which whether it goes up or down, you have a lot of assets behind it. So, we're not investment advisors, but I think that, while not a tax attribute, certainly might be an investment consideration.
Yeah, I know. For you guys, you're either all into this stuff and you know the terminology and all that probably better than we do, or you're like, I don't even know what this is and I don't care. Right. For those of you that are into it, so this kind of probably goes without saying, but one of the disadvantages we talked about earlier, you got to use some kind of software to track this basis and like first in, first out. Like, how do you track these things? We still don't, I don't know, we have better guidance maybe, but still have kind of limited guidance on how we track the basis of these investments. So there still is kind of some ambiguity there. It still seems like you got to use some sort of good coin tracking software.
We've had more than one return come through Anderson where we didn't have good tracking of the trades, and it's really a disaster because the client has to go back and really reinvestigate purchase and sales prices. So a good software. Go out there, do your due diligence, search around.
Yeah.
It's imperative that you have really great software to track it. So that's something you want to throw in there because that's going to be a cost. Maybe we could deduct it, maybe we can't, but nonetheless, we have to have it.
Right.
So that's something to take into consideration as well.
Excellent. Well, any questions related to that we want to touch on?
No, I think we're good.
All good. All right, let's keep it moving. Same theme here. I do a lot of stock buying and selling. Is it tax efficient to set up a business entity? Great question. We talk about this a lot, using a corporation for tax purposes. Any use for that here?
You want to draw something out here, maybe?
Oh, yeah. Let's get on the drawing board. What do we got?
So we got Barley investing here, okay?
Me as an individual.
Yes. And let's say he makes $100. Right now, and this is, again, a capital asset, so he trade his share of IBM or whatever has $100 or 100,000, I guess. That's good too. Right now, it all hits his personal return. It's going to be taxed either at short-term capital gain rates or long-term capital gain rates. The bigger story here is just 100% goes to his 1040 to be taxed. Now, if we take that same example, that same 100, and we put it into what we call a trading partnership, it's the partnership that has the account, okay? But it is a partnership. That means it has what? Partners. And we're going to have a C corporation that owns 10%. And then Barley will still own 90, okay? So we have a 90-10 split. This is very common. But that same $100, just by simply putting it into the partnership, we took $10 off of his 1040. He only has 90 now. That $10 never suffered the taxation on his 1040. Now it gets,
so we immediately reduce taxable income to the 1040.
Absolutely.
Right, but I still want that $10.
Well, but we come back and they'll say, well, hold on, guys. I'm smart enough to know that C-Corp's at 21% flat tax. It's going to have to pay tax on that. In this case, $2,100 on that $10,000.
And that's higher than my capital gains.
Exactly. So thank you for
What's
nothing.
going on
right?
here? Yeah.
Well, but we have that treasure trove in our C-Corp of things, that goodies to help them with that $10,000. What are you going to, you open up that big box of goodies, what are you going to find there?
What's that thing called? The accountable plan for reimbursements, right?
Very nice.
You heard that laundry list, right? Cell phone, internet, home office, meals, miles, travel, 280A meetings, medical reimbursements. Those are always, you can pull all that cash out of your corporation. No questions asked. It's a reimbursement. right? Tax-free to you and a deduction to the company.
Exactly. He's gonna deduct that against that $10,000 and he'll probably wipe it all out in this instance. So now we have nothing taxable in the C-Corp. He's got $10,000 of tax-free money in cash in his pocket, and he only had to pay tax on $90,000 on his 1040. It's a win-win-win. Okay, it's very hard to beat that arrangement. And there are other things that we can do to add to that. We can have a guaranteed payment. That gets a little bit more involved. But the C-Corp could be paid more, which creates a greater deduction on his 1040 if we need more income for those, what I call, again, the treasure chest of reimbursements, a 288, which isn't really a reimbursement, but it's tax-free money, certainly, and get all those back. If we had a lot of money, we talked about some other things we could do, maybe pay you a payroll. Why would we want to do that?
Right. Yeah, and this is crucial if you guys are, especially for those, if any of you are transitioning out of a W-2 to managing your own investments, put on the tax hats right now, because this is crucial. This corporation will take the place of your employer in that you can put yourself on payroll, pay yourself W-2 wage.
But why would you want to do that?
Set up a qualified retirement plan, like a solo 401k. By the way, we get unheard of contribution limits. If you're a closely held, family-held corporation, like the majority of you are, we get 10x the individual rate. IRA, individual retirement arrangement, 7,000-ish contribution limit. Solo 401k, 70,000, 10x that. Am I pushing buttons here? Sorry, guys. 10x that. So this is a massive benefit. You have to be on W-2 payroll. But so it'll put you on payroll, set up a qualified retirement plan, reimburse a bunch of your common expenses, including medical.
And if we have heavy W-2, if Barley takes a really, really large salary a couple years, if we have a lot going on here, even a defined benefit plan, which is pretty much the Cadillac or Mercedes if you're German, and that's the heavy, heavy deduction, lots more. You can put in several $100,000 into those plans. So a lot of good could come from this, all from the fact that he just moved his trading account from him personally into his partnership. Yep. Now, one caveat, if he'd already been up, remember Barley talked about realized gain. If his stock had already gone up and he puts it into the partnership, he really has to have that gain come back to him on that sell, even though it's in the partnership, because you can't put appreciated property into a partnership, sell it, and avoid tax to the individual.
Right.
But any new gain that happens after that will play out the way we just showed you here. So it's just something to keep in the back of your mind. But it can be really a great tax play. And that was all kind of a run through of capital gains and investments. All of those examples, they could be doing this type of thing, having that partnership. So we curated it up to this point. Good word there, curate.
Yeah, right. All right, let's go into the cap gains. Or move on from the cap gains, rather.
On with that.
So this can be a great opportunity to set up a corporation. We refer to that as the trade structure, guys. We got a great video from Toby on that. Plenty more guidance on that. Let us know if you have any questions.
It's always going to be in those Saturday events that we have. They talk about it a lot there, too.
Right. All right. Oh, okay. We're getting into the real estate. As you guys know, this is our one of our primary focuses: real estate, small business, stock trading. Right. Let's hop into the fun stuff. I guess I know this applies to many of you, so looking forward to hopping in. Want to kick us off there, Elliot?
Yeah. So a lot of big words here. Can you explain what differentiates whether a real estate rental deduction would be categorized as maintenance repair deduction versus a capital expense deduction, and provide examples? Please explain how these are treated differently from a tax perspective as well. So a lot of information we got to throw out here. So yeah, the repair deduction. Repairs are simply things that just amounts that you put out to keep the particular asset moving forward in its normal state of repair. So it's going to be maybe a broken window or something like that, but it's going to be just keeping it in an ordinary, efficient manner is the idea here. Does not materially add to the value by including that, by putting that in there. It does not substantially prolong the useful life, and it does not, nor does it give a new purpose or a new ability to use that asset in a different manner. Those are the three characteristics really of a repair.
Right. Hop in here? All right, cool. Yeah.
What about a capital expense?
Yeah, so capital expense, and I like the window example. We fix a broken window, that's a repair. We replace all the windows in the house, that's a capital improvement. Just like Elliot said, fixing a broken window, we're just bringing it back to its original purpose use.
Yeah, the capital, basically, that's more of an permanent improvement, a betterment to the property. We are increasing the value. We are substantially increasing the useful life of it. And we very well might be changing the adaptation or readapting how we use that asset. What are examples? We go back to repair. That's going to be, we talk about patching the roof. That's an example that, that we talk about all the time. Repainting. Fixing leaks, things of that nature, repairing the broken window, those are all repairs.
Right, not capital expenses, yep.
Right, now we get to the capital. You're thinking more involved. Let's say, Barley had me repair his roof. That was one thing. I had a little patch up there. Now he calls me to come over to his rental. And 40 pounds ago, I get up there on top that I'm repairing that thing and I fall through the roof, okay? Well, now we need a whole new roof. That's gonna be massive. That's gonna be an improvement. You're gonna capitalize that one, add it to basis, depreciate that, and get Elliot on a weight plan. All right, that's going
to improve the house. It's going to raise the value of the house. It's going to extend the life of the house. All of these categorical requirements that the IRS wants to see for a capitalized improvement.
Exactly, increase the life. And again, it could be if you change a widget machine to making Muppets or something like that. You've taken an asset, changed it to a whole different purpose. That's going to be a capital expenditure. So again, what's the differentiation? It's really about the long-termness, if you will. Now, there's a few exceptions to this. We talked about that de minimis rule.
Right. Yeah, and you're absolutely right. Why do we even bring this up? Because generally, repairs can be deducted right now. Right? If I fix the window and it costs $500, I can report that on the profit and loss statement this year and take it as a deduction. If I replace all the windows for $20,000 or something like that, then I am required to capitalize the purchase. So just that's why we even care. Let me back up. I'm required to capitalize the purchase. What does that mean? It's required to be depreciated over time. I can't deduct the $20,000 right now in this current period. I'm going to put it over 5 or 7 years or whatever the life of the asset is. Divided by 7, I take that much each year, right? So it stretches that out. We'd rather have the deduction up front, right? So we want to look at this a little bit of an art and a science here. Obviously, we have to categorize it the way it has to be categorized, but we do have a little bit of flexibility if we make what would normally be considered a depreciable, a capital improvement rather, if the per ticket item is less than $2,500. We have a de minimis safe harbor rule. And the reason I'm just bringing this up because for you guys doing real estate, this means if you buy something less than $2,500, appliances, furniture, flooring, new windows, that are normally required to be capitalized, you can just write that off in the current period. You don't even have to add it to the depreciation table. So that's kind of a benefit.
Absolutely. And it is by ticket, if you will. In other words, if you went out there one day and bought a dishwasher under $2,500, you're safe. Then go out and buy cabinets for under $2,500, you're safe. Those are considered independent $2,500 tickets, if you will. But the IRS caught on and said, well, but if this is a bigger theme of overall renovation of the whole house, well, you can't just, piecemeal all of it and expect to get it all as a current write-off. We're not allowed to do that. But there is another way that we can still hit that, and get out of that capital expenditure realm into the current, deduction of it, even though it would be traditionally a capital asset, and that is the routine repair. Whatever the lifespan is, Barley mentioned 7-year, 10-year, whatever it is for that particular asset, the depreciation life, if it's reasonable to expect that you're going to have to add some maintenance on that or kind of repairs more than once within that life, that useful life, then we can go ahead and expense as well. So those are two unique cases where we are in the capital expenditure world, but we're allowed to get over into the repair world where we get that immediate deduction that Barley was talking about as opposed to the longer term depreciation.
And as usual, guys, this can go way in the weeds, right? Lots more guidance there. And the theme here is if this applies to you and you have a specific question, let us know. You can shout us out right now in the Q&A or submit a question to the Platinum portal, or if you need us to crunch some numbers, set up a call with the tax advisor.
Get to that Toby's toolbox.
Yeah, that's right.
All those videos.
So
I know
much good content.
Scott and Toby go over this one for sure.
Right, absolutely. So, certainly let us know if you have questions on that. These rules get pretty hairy, but we can certainly provide a lot of guidance based on your particular situation there. How they're treated differently from a tax perspective. Yeah, that's pretty much it. Repair versus whether you need to capitalize the asset.
We beat that one to death.
Right. Hey, good. That's good. This is a good one. Can I deduct lost rent from a deadbeat tenant?
Good question. We get this surprisingly a lot. And, when you first start getting into taxes, you kind of think, wow, they have something here. What's going on there? Guy didn't pay me. Yeah, can I get a deduction for that? Well, we got to go back to what the definition of a deduction is. A deduction is somewhere you've had this expenditure towards some services that were provided you or maybe an asset that you purchased, but you had outgoing money. You had to pay something. But income, your rent, it's incoming. It's rent coming in. That's a whole different concept than you passing money out to pay for something. That is, no money came in. It's a different category. We call that's what's actually going to determine your taxes. So there's no deduction for missed rent. It's just that you didn't get taxed on that rent. So in other words, I'm renting from Barley. No surprise, I don't pay him. Okay, I don't pay the rent for $1,000. The fact that he didn't get paid it, he just didn't have $1,000 that he had to show up on his return as income, okay? But he doesn't get a deduction.
I didn't spend anything, right?
Exactly, because he had nothing to spend because he trusted Elliot, right? Never do that again. So we get to that situation where we had no income. It's certainly not a deduction. However, if you really look at this, it might be an opportunity, lost income, choices of what you could have done. He could have a different renter, or if he had that $1,000, it's really opportunity loss, not a tax consideration. That's more economics and things like that. So not much we can do with the lost rent other than we just don't call it as income because we were never paid it. So we have that grace in that we didn't have to pay tax on it, but that's it. But it's certainly not a deduction.
And just to get a slight tangent there, if they didn't provide any income and you're still going to have to pay the property taxes, mortgage interest, all that. If that creates a loss, that you may be able to take that loss. That's where we'll talk about terms like real estate professional status, material participation, stuff like that. I don't think that's what you're asking, but just to throw that out there, right? That could be a passive or active loss, kind of depending on the situation.
Excellent point.
All righty. Any questions on that? I don't want to skip over anybody.
No,
All good there? Good. All right. Okay, let's dive in. This is a great one because we're talking about primary residence. This is kind of this is a mix of it, like a little bit of everything that we've talked about so far. I've heard you talk about renovations made to a rental property and the tax advantages, but what about for my primary residence, where the home I live in? I need to finish my basement and upgrade the house. This is also the address my C-Corp business is registered to, i.e. I operate a home office out of it. When I complete my taxes next year, are there any specific advantages I can take advantage of due to this large expense? Great question, because normally, if we're talking about our primary residence, right, there's not going to be a lot of tax. You can maybe deduct property taxes, mortgage interest on your personal deductions on Schedule A. Yeah, if you're itemizing, but generally not a lot of deductions there. But we do have the home office, so a couple angles we could pick this apart from. Where do you want to start, Elliot?
Yeah, no, Barley's exactly right. Primary residence, not a whole lot to work with there. Certainly, it's not a business asset, so there's no deduction except for property taxes, perhaps, and mortgage interest. Your ordinary wear and tear items, you had to put a new window. What about those things we were talking about? You had to repair a patch on your roof or something like that, where Elliot fell through. Those things are not deductions because it's not a business. And that's where we kind of get thrown off thinking
deducted against what income?
Exactly. But what if you add on a new room? Or you do a whole new roof or something like that? Well, those are those capital expenditures we were just talking about not too long ago. Those will be added to basis. What's our basis? That's what you originally paid for it. If you paid originally $200,000 for that house, Barley goes in there, puts a new roof, maybe an addition, another room, adds another $50,000 of expenses. Well, now his basis is $250,000.
Right.
Why do we care?
Well, it depends when we go to sell the asset. Sales price minus our adjusted basis, or our basis there, it will equal the taxable gain, the gain on the sale there. If we don't add those capital improvements to the basis of the assets, we're just going to pay tax that we don't need to be. And that goes back, this really does tie in. We talked about before, if we fix a broken window, do I need to keep that receipt? No, right? If we make capital improvements, right? Go back to that original definition. If we make capital improvements, all you really get, there's no tax form. You just want to keep those invoices, keep those receipts for if and when you sell your primary residence. That will reduce the gain on the sale, because that'll just be considered it's going to be your purchase price plus whatever you invested into it on top of that.
So it's not really a deduction until that day we sell.
Right.
But at that point, you'll be glad that you kept those receipts and can show proof of what your new increased improvement basis was.
Yep, so offset that gain.
Yeah, but we got this other thing where we have the office going on.
Right. So also happen to have a C corporation set up, like many of you do, and we're also using the primary residence for administrative use of the home. We're renting a home office to the C corporation, so we can perform our administrative duties for the C corporation. I guess is how you say that.
Exactly.
So I operate my home office out of it when I complete my taxes next year, anything specific. So now we're talking about home office, and we tell you guys all the time, home office through a corporation, we get reimbursed through this good chunk of our living expenses based on the exclusive use portion of the home, right? Well, that's where we can possibly include part of these improvements.
Right. We got the administrative use of home. That's one of the reimbursements we can do under our accountable plan. Accountable plan, just fancy IRS term for reimbursement.
Yep.
You paid something out. You paid for the expenses related to your house. Those related to that office space, you can take as a reimbursement. Usually we go by square footage, how much office space is being taken up out of the entirety of the house. Gives us a percentage so we can look at certain expenses like those property taxes, the mortgage interest, anything else
HOA,
like that.
your utilities.
Now again, I have to come over and tell Barley why I didn't pay his rent. So I come to his home, okay, and he's got his little office there in his house. He's brand new white carpet in there. Being the good guy he is, he gives me that fruit punch drink to go up there and, well, let's talk about it in my office. And I spill it all over his white carpet in his office. Now he has to change that out. That is a direct expense, directly related to his office. How much can we deduct there on that repair?
Direct expenses we can deduct 100%.
100%.
And what Elliott's distinguishing there is anything in the actual office space itself, right? Shelving, an internet booster, maybe put some carpet or flooring in, right? Those are all going to be, you can take those at 100% deduction because they're directly related to the office space. Whereas your gas and electric bill is related to the home office, so we can only deduct the business use portion we determine that from the percentage use of the home.
Yeah, so if we did a roof repair or something like that, we're probably going to break that out. That's indirect. Even if it was right above the office, we're probably going to still call that indirect, even if Elliott fell through that too. So things to think about there. So here, the renovations added our basis, allowed us to, and if it's a direct expense, we can take that as a reimbursement through our office. We get asked a lot about depreciation for the office. You can take, it's possible you might be able to take some depreciation on that office space. Just a caveat, if you ever sold your house later on, it probably is subject to depreciation recapture. So a little bit more pencil and paper we got to take to it to keep track of all that. But that would certainly be in the possible realm as well.
But for those of you with a corporation, this home office deduction, because you guys are entrepreneurs, it's not like you're not doing work at home. We know you are. So as long as you make it an exclusive use space, this is kind of another thing about those accountable plan deductions. Wash, rinse, repeat. These are the kind of deductions we want to kind of put on autopilot, right? Maximize the deduction and then just put it in place where we just put it on autopilot. We take it every year and we don't have to think about it, right? That's really the goal here. You're going to be just taking us the same percentage of the same bills each year.
And there we have it.
All right.
And just jumping back to our earlier question where we talked
this
about
ties a lot in,
the trading partnership. We had that $10,000 go into your C-Corp. This is exactly the kind of reimbursement we'd be able to use against that.
Yep. Administrative use of home.
Yeah.
Plus everything else, right? Watch that accountable plan video from Toby. All right.
I think that's it.
Cool. Can I do a 1031 exchange on real property? Is this a trick question?
It is. It's tricky.
What's the answer, Mr. 1031 exchange? Well, obviously we are talking about real property, real estate, right? So yes, a 1031 exchange is used on real property. In most cases, there are certainly some exceptions. Surprise.
Right, go figure.
What are some of our exceptions? Well, we can't 1031 our primary residence, right? That's one exception. What else?
We can't do it on inventory.
Any of you guys that are doing flip houses, you can't 1031 exchange a flip property. And just because it's considered inventory as opposed to real property.
Right, and just take a quick step back to what a 1031 is, for those of you who don't know. It's where we have a business asset, an asset using a trade or business or as an investment, usually, let's say a house. It has to be real property, house, land, something of that nature. That's not getting flipped, as Barley pointed out. We can, if we want to sell it and we're going to recognize a gain, maybe we don't want to pay tax on it. There's a novel idea, don't pay tax. Well, the rules say that if we go out and buy another like type property, could be a commercial building, could be a single family rental, whatever it be, we can maybe defer that gain. And if we can defer that gain, we just don't have to pay tax down the, we kick the can down the road. And if it finally goes on to the time when we pass away and we leave it to our heirs, they're going to get stepped up basis, no tax at all on that. But getting back to the 1031, the idea of how do we know if we can fully defer that gain on that sale in a 1031? Well, there's just three things basics that we want to look at. Number one, you have the sales price of it. You sold your house for $100,000. You subtract from that your adjusted basis, which we talked about earlier. That's going to be the purchase price plus any of those improvements, those capital improvements, less any depreciation. That's your adjusted basis. Subtract that from the sales price of your house. We have what's called the gain. Once we have our gain, in a 1031, you're getting one property. That's the relinquished. You're picking up a new property. We call that the replacement. If we get the new property at or above the fair market value of what we gave up.
Trading up in value.
Exactly. Mm-hmm. And if we picked up as much or more debt on that new property.
Same with the debt.
Exactly. We know we're going to have full deferment, 100% deferment on that gain that we just learned how to calculate. Mm-hmm. Okay. Lastly, something that people always ask about the 1031, we have that replacement property, a property we just purchased. We take away, subtract from that price the amount we just deferred of our gain. That's going to give you the basis in the new house. It's a real simple calculation there. But all that, can we do it on can we do a 1031 on real property? Absolutely, as long as it's not inventory. It's got to be used in a trade or business, so it's not our personal residence, right. Things of that nature.
Mm-hmm. And the next couple, we're going to be going into more of this gain. The next couple questions are dealing with that as well.
Kind of feeding off of it.
Yep. So let us know if you got any questions on that, guys. We're going to hop into more detail on that right now. I bought a rental property in California in 19 for $700,000 as a replacement property from an exchange. $400,000 was from the sale of the property in Washington, and $300,000 I put in cash myself, or the client put in cash herself. Took a loan of $600,000 for expansion and repairs in 2025. How much of the money I invested from my personal savings can I get back without having to pay tax? And when are we talking about here? I've listed my rental house for $935,000. So we're assuming here, when I make this sale, how much of this cash can I get back and not have to pay tax? So, great question. We can look at this from a couple different examples, but essentially the main kind of question here is, are you going to do another 1031 or not?
Exactly. We've got two paths.
Right. And either report the capital gain or do the 1031 or not. And really, that's kind of the crux of the issue.
It is.
The rest of this calculation is I'm not going to say it's irrelevant, but essentially are we going to use a 1031 for deferring our capital gains, use that kind of vehicle to defer our capital gains, or are we going to take the capital gain? Kind of right in the middle there, if we do a 1031 but pull cash, that definitely will be taxable as boot. So let's break those kind of three pieces apart there.
So we have the first path. We don't do any kind of 1031. We just simply sell.
Sale of a capital asset.
We know we're going to pay tax, okay? Because again, we just talked about it. You're going to have the sales price less your basis equals your gain, the gain that you're going to pay tax. And so whatever cash came in, you're going to pay tax on it. And whether that's going to pay off debt or if it's going to pay you back for the $300,000 you put in, no matter what, tax will be paid. No question about that.
And that's important too. You have to pay the tax, and then you can redeploy the capital however you want, paying yourself back, reinvesting it, or whatever. The tax would be due first.
Exactly right. Now,
you know how the IRS works.
Right. Yeah, they're going to take their chunk first. But if we do the 1031, which we defer, which is how we got into this situation to begin with, well, that's fine. As long as we, again, meet those criteria that you picked up a property that's more expensive, over $935,000, what you sold it for. You picked up more debt, whatever the debt was. We had $600,000 on a loan, so we know it's probably going to be at least that much. As long as you pick that up on a new property, a replacement property, well, you're going to defer all the gain, so you aren't going to pay anything. However, there's that middle road that Barley was talking about. What if you took some of the cash out of the 1031 exchange? That's going to be boot. Anytime you take $1 of cash back in any of these situations, you're going to pay tax. There isn't any way to avoid that. If you're going to take cash, you're going to pay tax. Period. There's just no way around that. But we know we're in the real estate genre here because we're talking about they have a rental, they're going to get a new
Done
rental.
a 1031 before.
Right. And if they get new rentals, so it sounds like that there's some things outside of this transaction that we could do in the real estate game. Maybe a short-term rental. What do we have going on there?
Yeah, it's right. And like Elliot said, I like how he approached this, because since you're already in rental properties, you've done a 1031, you obviously have some experience in the rental world. I mean, so in other words, we might not just suggest this strategy willy-nilly, but you could use a short-term rental with material participation, right? Just to throw some tax terms at you. But if we materially participate in a short-term rental, it's considered an active business. Any losses can potentially offset our other active income, W-2, all of it. If we do a cost segregation study, take bonus depreciation, again, as long as we materially participate in the activity, right, we're the ones managing it, at least for the first year or so, we can lock in those good losses. And that'll offset all other, well, if you materially participate, right, got to stress that then that will offset all other ordinary income, including capital gains.
Absolutely. So that's a surefire way, if we still want to stay in the real estate game, maybe add to it, that we could offset whatever gain we have here. The other, if it's a long-term rental, a little more involved, we have to make that real estate professional status, over 750 hours in real estate trades or businesses, over 50% of our work week dedicated to those trade or businesses.
Right.
And that same test Barley just went over, we have to materially participate in the management of each rental property we have. We meet those. Those are two ways that we could stay in the real estate game, get a write-off that will, separate from what's going on in this 1031, it could offset cash if we didn't, our taxes, if we didn't go into a 1031, or if we pulled some cash out. These are things to mitigate that tax.
And you've heard Toby say this in kind of in other words. If real estate is your primary business, you have a little bit of choice on kind of that. You have a lot more control, I should say, of when and how much taxes you're paying. If you're a real estate professional and you're materially participating, maybe if you aggregated your rentals together, then we can use. It's just kind of interesting how you can build your real estate portfolio while still getting these big taxes.
Absolutely.
This is kind of why we do this. So,
especially with 100% bonus depreciation, it's not out of the realm to be able to offset an extensive amount of this game, possibly all of it.
Right. Yeah. Absolutely. So, great question. Bottom line there, you're working with a qualified intermediary. If you have any cash out from a 1031 exchange, that's considered boot and is taxable as at ordinary income, or 25%. So that's kind of a given there. And of course, you could just sell and take the capital gains and reinvest the capital, considering that capital gains rates are considered favorable rates, right? They're not terrible.
Certainly better than ordinary.
Right. Definitely better than the ordinary rates. Excellent. Any questions on that one?
No, that's it.
Doing good. All right.
One last question, a biggie.
All right, now we're going to tie it all together even more, right? I'm selling my personal residence next year. Okay. We currently have an anticipated capital gain of $1 million. I'll be paying taxes on 500,000 capital gains above the 500,000 capital gain exclusion, right? We're talking about 121, section 121 exclusion for married filing joint. So we're married filing joint, we know we get the whole 500K. What tax strategy would you suggest that I may plan to use in order to mitigate paying federal taxes against the 500K capital gains? Could I do a 1031 exchange of a personal residence? Well, we already covered that. Can I convert the personal residence to a rental and sell it in 1 to 2 years? That sounds like an option. I've heard Toby talking about this, sell your residence to your C-Corp, but I don't have an C-Corp. Well, that's okay. We could set one up. I currently do have an LLC just for managing, just a disregarded LLC for asset protection. Please advise on how to avoid or mitigate paying a large tax bill on an anticipated $500,000 capital gain from the sale of a primary personal residence. Great.
So the first thing we want to tackle is the 121.
Right.
We're selling our primary residence, and all of a sudden, the individual asking this question is saying, I can chop $500,000 off. We call that the 121 exclusion. 2 criteria.
Right, ownership and use.
Exactly. 2 of the last 5 years, you got to own it, and you got to use it as your primary residency. As long as you do that within a 5-year period, then if you sell it, you can take off up to $500,000 against the capital gains. If you're married filing joint, $250 if you're single. So that's what is being referenced here. Why we can cut that $1 million capital gain in half immediately.
Right. And exclude, not defer. Exclude, gone forever, right?
Yeah.
It's gone forever.
Much better than just deferring. Right. However, they mentioned, can I do a 1031 out the gate? Well, we talked about that.
Right.
Can we do that with our primary residence?
Not initially, not as a primary, not as a personal residence.
Correct.
Right.
What do we have to do?
We may be able to convert that to a rental. We can convert the property to a rental asset. That's certainly an option. We just don't have the option of using your primary residence for a 1031 exchange. It's not a business asset.
But if we turn it into a rental, we've now used it in a trade or business. And if we go back to the earlier 1031 questions, that qualifies. So now we have the best of both worlds. As long as we sell within that 5-year window, because remember, we still got to capture that 121, 2 of the last 5 years. So you have technically up to 3 years to run it as a rental. I wouldn't get that close.
Right.
Maybe only 2 years or 1 year or something like that.
Right, you got to market it, put it on the
Exactly, right? Could take all kinds of things can go wrong and usually do. But you get that $500,000 write-off and now you can 1031 into a new rental. Mind you, it's not going to be a new primary residency for you. It's going to be a new rental property, but you could do that as long as you meet those criteria. You pick up a property that costs more basically than what you gave up. You pick up more debt what you gave up. You fully defer that gain. And there, right there in that case, you wouldn't pay any tax, any of that. That would be your huge mitigation. But we talk about this S corporation. What we got going on there?
Yeah, we want to convert it to a rental. What do I just wave a magic wand or something?
Sure.
And then it's a rental?
Yeah.
Is that how that works?
Could be. But if you want to sell it to an S corporation, you got to set up the S corporation. They mentioned that here. If they don't have one, well, then set one up.
Right.
You can sell your primary residency to your S corporation. When we do that, it's going to be at the fair market rate. So you're going to get stepped up basis in your S corporation.
That's the key. Yeah.
And now we can run it as a rental through there.
Yeah.
And you got far more in the way of depreciation, your straight line depreciation. But what about cost saving bonus?
Oh, yeah. We like those, don't we?
We do, but we're selling to a related party. We're selling to our own S corporation. So you can do a cost segregation because you're using it in a trade or business, but we can't do bonus depreciation because it's a related party. So you're going to get some tax benefit, but it's not going to be the 100% bonus depreciation everybody's craving about right now. But you're still going to have some gain probably. And what about that gain in this situation where you sell to a related party?
Right. So what we're talking about is you can. So I have my primary residence. I want to convert it to a rental. And what we're proposing, you could sell it to your own corporation that you own and control. You get a step up in basis if the house has gone up in value, and then we can depreciate the higher rate. There are some downsides to that. We're typically going to do that on an installment sale. 1, it's going to be a related party transaction. 2, these are going to inherently create some restrictions, like we can't defer the gain.
Got to pay it right away.
All the gains due up front. We can do an installment sale, have payments over time from our own S-Corp. It's just our own money though, right? So we have to keep that in mind. But all the gain is due up front. So this is a little bit more of an advanced strategy, but you can get the step-up basis, convert your property to a rental, and then have it be a cash-producing income, a cash-producing property. A little bit of a seasoning period there probably. But well, I guess if you sell your S-Corp, that would probably instantly convert it to a business asset. If you took the S-Corp out of there, you want to have it be a rental for a year or two before you try to 1031 exchange, just as a side note.
But yeah, you're going to have to pay that tax up front, and that's usually a killer because you're not having an influx of cash coming in from the sale. It's your own S corporation, so it's not going to have that cash. And that's probably the nail in the coffin why people don't do that. But if we were able to get into a 1031 exchange, we fully defer. Well, we don't have to worry about any of that tax. It's all been deferred. So.
Yep. Absolutely.
Yeah.
So there's a great Clint video on this, just FYI. If any of you are interested in that, shoot us a Platinum Portal question or shout us out in the Q&A here. I can certainly provide that, kind of walks you through the steps of that, why you'd even do it and what the benefit is, kind of a little more detail there. But let's see, please, how to avoid or mitigate on the 500K. So yeah, essentially you wouldn't avoid the taxable gain there. I mean, how do we avoid the taxable gain on that? Well,
there's no avoiding.
You don't. You're going to owe tax on that gain. Yeah, you'd either defer it or you can offset that with, like we talked about earlier. If you're anticipating a large gain of any kind, selling a business, selling your primary residence, selling a business asset, selling some stocks, whatever the case is, that's where we can kind of kick into gear with these tax planning strategies. Maybe we do a short-term rental, or maybe we look at selling some stocks that have gone down in value to do a little extra tax planning there. But what else can we touch on in this one? I feel like there's so many pieces to this.
But keeping it in the real estate realm, that's pretty much it.
Right.
We can do there.
All right. Any questions we want to touch on?
No, I think that's it.
All right. Well,
Attacking all of them.
geez, good work, guys.
Yeah.
Let us know if you got any remaining questions. Looks like we got through all of our questions.
144 by our team, and I'm sorry I don't have everybody on there, but it looks like it's we got Patty out there, Troy, Ross, Amanda, Marie, and George. And I see.
And of course, our
Rachel.
tech team keeping us in line.
Yeah.
Thanks, Zion. Thanks, Matthew. Got a great team back there. Yeah, thanks so much for tuning in today, guys. We are going to be going over a lot more of this. You're in the right place, but please check out those videos from Toby on the tax bill. We did a video on that somewhat recently, or we've been discussing that. So I know you guys have questions on that. Be sure to submit any questions on that as well.
Did the quarterly tax planning.
That's where we talked about it. Yeah.
And we're going to have some more coming up here with the next Tax Wise coming up around the corner. So
Yeah,
some more
right.
there.
So plenty more live events coming up. If you have any questions about upcoming events or any of that, let us know. We'll provide you a calendar or just go to the website. A bunch of good information there as well. And of course, make sure you subscribe to the YouTube channels, guys. Tons of good information there. Come to the live events. You guys know the drill. Las Vegas in September is pretty nice. We'll be there answering tax questions.
Scan the square. Get in.
That's right. Scan the square for a free strategy session. You can set this up right now if you want. And how do we do this? Text Tuesday, every other Tuesday, guys. This is your questions. So please submit your questions here. Come check out the website and let us know if you have any questions in the meantime.
We read them all.
That's right. We go over them all. Anything else from you, sir?
No, just thank you.
Yeah, thanks, guys. Tax knowledge of the masses, well done. I definitely commend you guys for taking in all this tax knowledge all at once, and definitely look forward to seeing you guys again in a couple weeks.